Peter Rose, Longwood Currency Trading. It's mid-April 2022. Spring is coming around pretty good, and the question to try to look at today is, why does it always seem like every time you make your trade entry, the price goes against you? Why does that happen? Let's take a look at that. I'm still on a tea thing, no coffee. Still trying to get over this viral infection that I have. Today, I think, is a breakthrough. We're going to be all set. That doesn't help the trade entry thing with the price going in the wrong way. I just had a trade the other day that did that. It took a little bit longer to do that, went in profit a little bit, and then turned around and went against me. But it seems like that happens all the time. You know, I did a video the other day on trade entry uncertainty. And we talked a little bit about probabilities of what price could do. And really what we're looking at is not the far time frame, you know, where you would go on either a rising trend, a flatline trend, or whether it was going to go down, but more on the hard right edge point, what's the price going to do next. And we saw that there was a 50-50 chance that it was either going to go up or the price was going to go down. It might go up 1/8 of a pip or 1/4 of a pip, might go down 2 pips, might go up 100 pips, you don't know. But the probability is saying it's 50-50 jump ball that the next tick will either be up or down. So if your projection is, for example, that the price is going to go up in the long term, in other words, you're looking for a 20 pip profit target, and you feel that there's an upward momentum to the price over the long term, which might be the next 15 minutes or 5 hours or whatever it's going to be, to get that 20 pips, then you would subtract off the 50% probability that price is going to go down from the probability that you've created that the price will go up, and then you determine whether your expectation of price action over that immediate and longer term is sufficient for you to take the risk to make the trade, because the risk is the stop getting hit, right? So if you get that wrong, you get stopped out a lot. But the question is, why does it seem like price is always going against you when we take that trade, when we go into that trade? Well, there's 3 reasons. First of all, it is against you. Absolutely, it's 100% against you. As soon as you make the trade, the price doesn't even have to move. You're paying the VIG right up front. So if you've got a 1.5 spread, you've lost 3/4 of a point right off the bat by that trade, because that's half the spread, right? That's half the VIG. When you go to sell, you're going to pay the other half. Can't get away from the VIG. But negating that, you know, so you could have 100% certitude that the price was going to go up and set your stop a 1/2 pip below the entry, and 100% of the time you get taken out, regardless that you had a 100% chance that the price is going to move up, because you're going to pay the spread. You're going to pay half the spread. So you can't get around that. And that has to be figured into your stop. You know, there's a lot of conversation in the field about setting these short stops, because if you set a 5 or an 8 pip stop, and you're going to pay, if you get stopped out, you'll pay a 1.5 right away. Well, your stop is really only you know, 3 pips, 3.5 pips. That's the only stop room that you have, because you lose a 1/2 pip or 3/4 of a pip to start, and then your stop is at 5 pips. You only have a few pips left before your stop gets hit. So you know, a puke can take you out. So if you're only going for that 10 pip profit target and you're losing a pip and a half, then you're really only gaining 8 pips. Of course, it depends on where you set those things, and you take into consideration your VIG that you're paying there, that spread cost between bid ask. But regardless, that's a whole other consideration than what I'm talking about here. When the price actually does move against us, what's going on here? Well, because of the uncertainty of the next thing to happen, it's like a dice throw. If you throw well, let's not even go in dice. Let's just flip a coin. You know, it's 50-50 from that first throw. If you throw the dice 10 times, you may get a dispersed probability of 52% heads and 48% tails until you have enough time to work through and get closer to the true 50-50 odds. But at that first throw, it's hard 50-50. It's either going to be heads or it's either going to be tails, okay? So that's why it seems that price is going against you right at the start, because it's 50%. It's jump ball. You don't know what it's going to do. And that's where your risk setting comes into place. If you're going for a long profit target, then you can give your stop a little bit more room so that the jump ball movement of that price against you doesn't take you out. So there's the calculation that you need to make, because what's happening is that you got the timing of the trade wrong, or your win to loss is not sufficient to withstand the number of times that you get tapped out. Those seem like diverse things, but they're really the same. When you're looking at price action on a jump ball situation, a 50-50, the next question that you have to ask yourself when you're looking at your stop placement and the volatility around you is, what is the ATR of the candle that you're entering on? And at what point has that candle traversed? Or if you're entering on the next candle, at the close of that candle, that candle that you're using, you call that your trigger candle, that's giving you the, okay, I'm ready to go, because it hits some point and you go, that's the point I want to enter. That candle that you're in there, how much of the ATR has that candle traveled? Because you have to figure that it's relatively easy, particularly on the shorter term time frames, for that candle to go an ATR against you right from the get-go. And that's why on my the currency pair that I trade characteristically has a 5-minute chart, has a 5-period ATR. That's the expectation of this currency pair. Now, sometimes that ATR changes radically, but over the long run, my plan is that the ATR is 5, and so I set my stop at 8. That gives me a 1 ATR move from the point where I take that trade. Now, that candle might have moved up an ATR that makes me trigger the trade. If it reverses and goes an ATR, in other words, it retraces that, it forms what they call railroad ties, and one candle goes up and the other candle goes down, which ends up being a doji if you look at it in a higher time frame. But you wouldn't expect that if you've calculated the momentum correctly in your trade entry, that the negative movement of the candle would be at that new momentum, upward momentum that you're judging the validity of your trade on. And so you would expect that if you did set that short stop at an ATR, you'd probably be okay on short-term trading. Are you going to do that on a long-term trade? Say you're trading on a daily time frame. The daily ATR in the major 6 currency pairs can range between 80 and 120 pips. So let's say you had a 100 pip ATR for your daily candle. Does that mean that at the top of that candle where you're opening, that candle is moving up and it enters your trade, that you're going to set your stop at 100 pips? I mean, 100 pips is a lot of money on a full lot. I mean, that's just a lot of money. That's $1,000. You want to lose $1,000? Do you want to risk $1,000 and have that candle have your stop further and go to 200 pips, 300 pips? Where do you call yourself out? Because when we're looking at the shorter time frames, and this is why I trade on a short-term time frame, because I feel I have a greater control over my risk. I'm safer. But I'm only safe because I have a good win-to-loss ratio. And I know what my average win rate is. And I know what my per-trade expectation value is. So I have confidence that from a probabilistic standpoint, from a statistical standpoint, even if I'm wrong, if I'm a 60-40 trader and I'm wrong 4 times out of the 10, I'm going to make that up with the 6 times that I'm right, because my win rate is higher, my win-to-loss ratio is good, and I'm making sure that my stop takes me out short, so that if I lose 3 in a row, that doesn't equal is 6 times whatever my profit target is. You know, you don't want to set your stop at 20 pips with 10 pip profit targets, right? Because if you get whacked out 4 times at 20 pips, you're 80 pips out, and then you've got 6 winners at 10 pips, you're at 60, and you're out. You're out 20 pips over the 10 trades. So you have to be reasonable about what your expectation at entry is. You can have all of the analysis that you want, but it's 50-50 against you, and you have to subtract that 50% off of whatever edge you think you have. Which means your calculated edge has to be really big in order to overcome the trade entry 50% hit. You can eliminate that problem by making your stop greater, not having a short stop, by going out to 20 pips. What's the likelihood that if you're correct in your analysis, that it's going to go 20 pips against you? And that's fine, and that's what a lot of people do. My problem is being, having a degree in physics and almost a minor in math and all that sort of stuff. The probability of me hitting 6 losses in a row could be 15%, even with a 60-40 win-to-loss ratio. Because when you go into a loss, it has nothing to do with how good you are or how bad you are. You're just hitting the wrong probabilities, right? And so I always have to figure what damage could be done if I hit those 6 losses in a row. What's going to happen? And that's why when you get to the point where you're staging, because you have more money, you can resolve part of those losses by going in light and then staging heavy as you go up. As you're learning to trade, you don't have to worry about it either, because you're only trading with a mini lot. And so even though you lose a whole number of times, it doesn't hit your bank account, it doesn't hit your ego, so that you go on tilt when you're making those next trades, right? I mean, all of these things correlate together into this feeling that, gee, every time I put a trade on, it goes against me. No, it doesn't go against you all the time. Maybe you're not good enough to have a short stop. Your win-to-loss ratio is 40-60. You're losing 66 times and you only winning 4. So if you have that short stop, you're going to get that hit every time. But that doesn't mean that you should change the stop. It means you need to learn the trade entry correctly. I mean, this is stuff I talk a lot in my videos, and I'm sure I'm confuse a lot of people with this stuff. This is something that I sit down with somebody and we go, it's called a course. Because it doesn't come across in the video on a personal level for the individual that you are as a person. I don't know what your risk tolerance is. I don't know how old you are. I don't know how much money you could come up with if you had to reload your account. I don't know what your situations are, whether you're going to get rattled if the trade goes 3 times against you, and you don't understand that you're losing 50% of the trade just by entering the trade. I don't know who you are. And so all I can do is make the assumption that you do know what you're doing and you understand what I'm saying. Because again, I don't teach beginners. Because the stuff that I teach isn't for beginners. I teach beginners if they're willing to do the work in order to be a good trader. But I'm not going to answer stupid questions like, well, what setting should I put on my Bollinger Band, or how do I size my account? I will give you references as to what you need to learn before you spend any money with me taking courses or consulting. Because why would you pay me hundreds and hundreds of dollars to teach you how to size your bank or oh my God, it's not worth your money, and it's not going to be worth your time. If we go to the level of teaching that I would like to be at, let's start this over. There's 3 reasons why that price appears or would go against you. Number 1 is the vig that you have to pay on the entry. Number 2 is your win-to-loss ratio is probably not sufficient enough to do that. And number 3, you're setting your stop in the wrong place. And again, this is making the assumption that you have a good win-to-loss ratio and that you know how to set your stop, and that you then can vary that stop based on the ATR of the price that you're dealing with. And it has nothing to do with what you're doing up on the long term, because entry, to me, entry is entry. If you're doing a long-term trade, you want to be right. Why, if you're doing a long-term trade, would you set your stop 100 pips below because you have a 400 pip target and you jump up and down and say, I got a 4-to-1 reward to risk? Why would you do that? Because if you're not a good trader, you're going to hit that 100 pip loss 4 or 5 times. And you're not going to be able to make that up on the winners. You're not. So, in working in trade entry theory is entry theory, regardless of whether you're a scalper or whether you're trading up on the daily chart. And it all has to do with, well, where do you set your stop? Well, it has to be proportional to the size of the volatility of the price action, yeah, but not so sensitive, but not so lax, I should say, that you say, oh, I've given price room to breathe. If you say that, you better be a really, really good trader, because giving price room to breathe, if you're not really skillful in your entry, is the kiss of death. And you'll run your account to the wood for sure. So, though it may appear that price is going against you all the time, it's not going against you all the time, but it is probably going against you 50% of the time. And those are the things that you remember. You don't remember all the times the dog licked you, but you do remember the times that he bit you. And so if you don't have your trade entry quite right, your trade entry analysis quite right, then that 50% likelihood that price would go against you at the entry probably is what you're seeing happen. And you're simply not good enough yet to avoid that price going and hitting your stop if you're setting the stop where I'm suggesting that you set it at. I mean, I've worked with people before and they come back and they bitch at me, fucking stop, you're making me set the stop too soon, I'm getting stopped out every fucking time, all I'm doing is losing money. Well, it isn't because of the stop, idiot, it's because you don't understand the entry theory. So pay attention, I'm trying to help you. What are you going to learn if you set your stop out 30 pips and you lose 30 pips 4 or 5 times? Did that help? Or what if you set your stop out at 30 pips and it only goes 10 or 20 pips against you? And then goes around and it goes in your favor. Does that mean you know how to trade? I don't think so. Trade entry is an art. Price isn't supposed to go drastically against you if you were correct in your entry. If you're correct in your entry, the trade may go against you. There's a 50% chance that the trade will go against you. And because the edge that you have might be 3% or 1% edge overall, if you don't have a clear view of what the price should be capable of doing and moving in the direction that you want it to move in, you're gonna have a really bad experience as that price moves against you at trade entry. I mean, there are other considerations too when you get into the position management phase about your risk, and you can, I mean, even if you have a position that's in profit, you can still lose money if you don't know what you're doing. There's no guarantee. But I'll tell you what, once you are a consistent trader on the positive side of things and your win-to-loss ratio is pretty good, once you get that trade into the position management phase, and there's a very specific line as to when you can transition from trade entry analysis into position management. If you don't know where that line rests, you're going to get screwed because you'll be doing the wrong thing at the wrong time. Once you get your win-to-loss ratio squared away, and you've got a pretty good consistent, equity curve, they call it, you're going to find that 50% wrong move against you at that entry point is not going to be a 20 pip hit, or if you're short like me, and like an 8 pip hit, it'll go that half. It might go a half ATR, or it might go an ATR, 5 or 8 pips, and then stagger back up, and it may come back down, and then you go back up, and then maybe come back down, and maybe you go back up, and then it has built enough base, and off you go. The fact that it goes against you and chatters a little bit at entry is not necessarily a bad sign. You are a little early, but what the indication is, 2 things. Either it's building its base and getting ready for that next move up that you have anticipated, or you got the whole friggin' thing wrong and the order flow is being chewed up there, and it's just going to collapse then and go against you afterwards, but that would be because you had the theory of your premise wrong as to what the price was going to do. So if you're feeling that the price is always moving against you, what is your reference for always moving against you? If it's always moving against you and you're getting stopped out, that doesn't mean that your stop is wrong. It means you really don't understand trade entry, and you need to rethink that. If you're setting these long stops and they're getting hit more often than you would like to have happen, again, your trade entry analysis is wrong. I don't know where you're going to go to fix that. I know how to fix it, but I don't know where you're going to go to help figure that out, because it's a trial and error thing, but there's a progression to that trial and error to try to figure that out. And entry theory has to do with not only what the momentum of the price is, but all kinds of other things. You know, when I talk about entry analysis on the video channel, it's stuff like this easy stuff that we're talking about here to understand. But there's like 6 or 8 other things that are going on that you have to be concerned with. And not only do you have to be concerned with those things, but there's a sequential order that you need to consider them in order to determine whether you have a valid trade entry or not. It can get pretty complicated. It's not complicated once you understand how to break that stuff down in the component parts and order them sequentially the way that they need to be looked at. You don't even need to have a checklist to go through them. You just look at it and go, I got a trade entry here. Let's get ready to go. Or you go, nah, I'm going to have another cup of coffee. It's that simple. But it takes experience to get to that point. And if you're trying to do this on a full lot or 3 full lots or something like that, you're going to get so disappointed because the money value that you're losing. You're not losing probably an inordinate number of pips, but you're losing an inordinate number of money because your bank is too big. You know, if you're trading a $30,000 account or a $20,000 account right now and you're not having the success that you think you shouldn't be trading a $20,000 or $30,000 account. You need some guidance, okay? This video is for someone who is trading and they have a general idea what's going on, and they go, the price seems that it's going against me all the time and I don't understand it. Well, here's the 3 reasons why it's going against you. So only one of those you need to worry about, which is your trade entry analysis is bad. The other one, you got to pay the VIG, and maybe your stop is getting hit more often than it should. But getting that stop hit again is, that's trade entry theory or trade entry analysis more than it is, oh, I got to move my stop, right? I mean, I don't want to beat it to death. My tea is gone. Good enough. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.